saying the following: "I'm willing to testify on the 13th next week." Jumping on the phone for us, Sonali Basak, Bloomberg's Wall Street correspondent. Sonali, walk us through what we've learned in the last 20 minutes.
So he said that he would be willing to testify on the 13th. So I think questions on whether he shows up in person or not. He said that he'll try to be helpful during the hearing. He's trying to shed light, as he says on Twitter. Very standard way of him for him to communicate these days. He wants to communicate the U.S. businesses' solvency and ways that they could return money to users and what he thinks led to the crash. Remember, he's done a series of interviews with different media outlets already, including crypto publications as well as mainstream media. And he did online, as he agreed and said he's willing to testify, said he was sorry and that he's going to speak to his own failings. Remember, this all comes as U.S. prosecutors are probing the collapse. The New York Times reporting yesterday that he's also facing a market manipulation inquiry based on the collapse of the two cryptocurrencies that collapsed earlier this year and whether his hedge fund Alameda had orchestrated trades that led to those collapses. So the question for me then becomes, how broad will the line of questioning go on Tuesday? Tuesday, remember, is the House under Maxine Waters, and then the next day will be at the Senate, and will he be there both days?
Sonali, be here. That's what I want to focus on. Is he going to be there? Is he coming to the United States? Or are we expecting him to stay in the Bahamas and do the interview via Zoom the way he has done so many of these media interviews?
One thing he's just said on Twitter is that he doesn't have access to much of his data, personal or professional. The question I have about that is, why not? Where is all your personal and professional data? Is that not with you in the Bahamas? And do you need to come back here to get it? Your question is right. He has not been very clear on whether he's comfortable coming back to the United States. I would remind everyone that during the DealBook interview he had did, a number of days ago, he had mentioned, and he was asked specifically whether criminal liability was the reason he was not coming back, and he did not answer whether or not that was the case. So, as we were saying, multiple investigations going on at the same time, and unclear whether he's willing to personally come back here. But as we know, when you're looking at hearings in the House Financial Services Committee, typically people come in person. So the expectation is that he would be there in person.
Sonali, what have you made about how he's been treated over the last month or so, both by politicians and by the media more broadly as well, Sonali? What's your take on that?
There are a lot of frustrations, particularly by people who follow crypto closely, followed him closely, and have heard him speak over the last couple of years. My own sources, John, say that even his own employees were very frustrated, not just more recently, but over the last couple of years, because he was so public in ways that were not necessary for business at all times. Remember, his own personal affairs have spanned very far and wide, both politically, philanthropically, in terms of sponsorships, and a lot of his own employees didn't agree with some of the business that he was doing. So there is a big discrepancy here between people who are not deeply ingrained in the situation or have lost money and the people who have kind of come in more recently. A lot of folks feel that he's been given a very large platform to speak when really the whole story has not come out. And a lot of people tied to the situation who may also, by the way, be involved in these probes and, maybe trying to comply with investigations have not been able to speak themselves. One of those people that are potentially implicated here is he's thrown a lot of responsibility over to Alameda, the hedge fund that is in question here. And remember, Caroline Ellison was the person who was most recently leading that. We have not heard from her at all. So, he has had this large platform, but there are a lot of other people involved in this story. And, a lot of folks who have been trying to speak for him as well, they're not necessarily speaking for the millions of people who have lost money.
Sonali, thank you. As always, jumping on the phone for us. Sonali Basak there on the latest. AMH with us in the studio here in New York. Anne-Marie, some of that criticism has also been levelled at Maxine Waters, the chair of the House Committee on Financial Services. What have you made of that down in Washington?
Well, there was a report that they didn't want to subpoena him, and then she came out on Twitter and said that is not true. If it comes to it, he is not going to cooperate. There is a subpoena on the table. But there's been a lot of criticism because many feel that Democrats in general have almost cozied up to some of the crypto bros, crypto CEOs, the crypto world. And also something I don't think people really realize, on K Street, the big lobbying street in Washington, D.C., there is a ton of now crypto lobbyists. So there's a big question, I think, not just you say like the media, but also how Congress really grills him into what happened and where are these people's money?
Especially because Democrats have been thought of as the more heavily regulated type of party that want to opt for those kinds of policies. Have they moved away from that really with the crypto space? Has that been sort of what people are blaming for why we're seeing such an unraveling in certain sectors?
I mean, potentially it could be levied at the Democrats, but I think it's just also, this is so new for them. You heard Secretary Yellen, though, speak about crypto before. She's been pretty straightforward that this is a space she wants to look at and obviously needs more regulation.
But there's nothing new about calling someone to testify.
No.
At all. And the approach feels very different.
Oil executives are asked to come down all the time, flying in from Houston and get in front of lawmakers.
Do they get cozy tweets like this? We appreciate that you've been candid in your discussions about what happened at FTX.
From the Republicans.
To talk to the public will help the company's customers, investors, and others. To that end, we would welcome your participation in our hearing on the 13th. That was the invite for a man who's facing allegations of fraud.
I think most invites, to be honest, are pretty polite, but yes.
Over Twitter?
But the Democrats do, no, more so in a statement or a letter, but the Democrats are, they're getting a lot of pushback on why it's been a little bit gloves on with Sam Bankman-Fried, and the same way you see Republicans with
I've been scratching my head for weeks on this. What is it about this individual that is being treated primarily as a guy who used to be a billionaire and is now a failed CEO, and not a man who's facing allegations of fraud? Why we focus so much on the former and not the latter? And Tom and I talked about this in the last month or so, this obsession with wealth in the media, that he was a billionaire, and we seem to be more fascinated with this man because he was once really rich and now he's not anymore, instead of what he's being accused of.
I think that there is a larger fascination with the boom and bust story, somebody who rose up and then fell dramatically on a public stage. And there is a question around exactly the tenor of that and whether there are allegations. New York federal prosecutors are looking into that.
Sure.
There is a fascination because it seems like a person who is a mess. I mean, he's coming out all over the place. Lawyers are saying, stop talking. He keeps talking. It's sort of this public train wreck, and people are fascinated by it. You're right. There are questions where the people are going,
I just don't care about the theater about it.
Okay, well, a lot of people do. I think
real people who lost real money.
I would totally
on
agree.
that platform,
but also
and have big questions about where it went.
I would agree.
But also, I think the more criticism you throw at him, and if you were someone that at one point was backing him, you're in that camp. So
they're embarrassed by it. I totally understand all of that. They're embarrassed.
Also,
by
look
it.
who his lawyer is and his lawyer's previous representation.
Are you suggesting that the journalists that covered him also in the last year or so are embarrassed by the way they covered him?
They have been very vocal about that they got caught up in the story as well.
They were infatuated with him like a celebrity.
Do you think they're still caught up with it now, given how it's being covered?
I will let it.
No comment.
I will leave that there.
Okay. AMH with us in New York. Anne-Marie, fantastic, as always. From New York City, this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative.
It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
2 hours away from the opening bell, equities positive 0.5% on the S&P. On the Nasdaq, we look a little something like this, positive as well by 72 points, up by 0.6%. Next up for this market, PPI in about 60 minutes from now. Then on to next week's CPI coming up on Tuesday, the Federal Reserve decision on Wednesday, and then on Thursday, I believe it's the ECB and the Bank of England. Big week coming up for the bond market then. 2s, 10s and 30s look a little something like this. We've had the debate the whole week, haven't we, about where treasuries are going. 475 of your Wells Fargo, that's how high we could go. 250, that's how low we could go if you're HSBC. Somewhere in between right now, Lisa, your 10-year, 348.15.
Yeah, Apollo's Torsten Slok putting out that one serious shift in narrative right now on Wall Street has been toward this idea that perhaps we have a better sense of where yields are going to go, of where rates are going to go. Do we, though? I mean, that's my question.
You know, the one thing that Torsten's been great on, just to talk about the difference in the sequencing between Europe and the United States, and I keep going back, I refer back to that interview all the time, and I've rewatched it a few times as well. He said that in the United States, we're getting this story of inflation rolling over before growth collapses, and in Europe, it's kind of the other way round. We've got this story of growth getting hit hard, potentially even more so in the months to come, depending on what happens with the energy story, of course, before inflation really recedes. And that difference between Europe and the United States, I think, speaks volumes about the tricky position the ECB's in relative to the Federal Reserve going into next year.
And it really raises questions around one consensus, which is that Europe can perform better next year. And some people are even saying it can outperform, so it raises some questions there. I do want to just bring attention to a number of names. Evidently, people aren't buying men's suits from Lululemon, just like John Farrow. Actually, they are, but not as much as perhaps people are thinking. Lululemon shares are falling ahead of the open about 7% after reporting lower than expected profitability results yesterday, as well as an increase in inventory. This has been a big issue, and it really has been playing into the goods disinflation that we keep seeing. DocuSign, which is that online secure contract mechanism, is surging more than 11% after reporting better than expected earnings. And Activision Blizzard, I'm really interested in this story. The Federal Trade Commission is looking into potentially blocking Microsoft's purchase of Activision Blizzard because they don't want Microsoft to get too big in the gaming sphere. It really is probably the first time that I've seen a major push from the antitrust wing to this degree in a while, especially considering that Microsoft would become number 3 in the whole gaming world if they were to make this acquisition.
And I think some people also thought Microsoft, ironically, considering where they were 20 years ago, are immune to this kind of stuff.
Yeah.
Relative to the rest of the tech world.
They are actually probably pointed at as the least offender compared to, for example,
Sure.
a Google that
Meta.
has rolled up a lot of different smaller competitors, as well as Amazon. You know, but it's just sort of interesting to see what they're going after, and is this sort of a first shot before a more protracted kind of effort on
Although
that
I have to say, when it comes to Mark Zuckerberg, then we all like throwing mud at Meta. I've done it many times on this program. You've done the same thing. Tom has as well. I remember the mornings that he made some of those acquisitions. I remember being in London, whenever there was Instagram or WhatsApp, and I remember sitting there and thinking, what is this price? This seems absolutely ridiculous. And I think we all sat there and thought the same thing, that he was overpaying for all of the stuff that he was buying. And then it transpired over the years subsequently that those assets were worth multiples of what he ultimately paid for them. And I think that's the difference. It's easy looking back at hindsight, and saying that the acquisitions that Meta made, the roll-ups there of things like Instagram, like WhatsApp, were anti-competitive, he was buying competitors, blah, blah, blah. But I still remember that people thought at the time that he was overpaying for those assets, that they weren't that important, that he was paying too much money for them. And here we are 10 years later, and everyone's saying it should never have happened, shouldn't have been allowed, blah, blah, blah. We should unwind them.
But it's the difficulty of understanding the popularity factor in social media. What does it mean to be dominant? And you see a lot of, for example, Apple or Google sucking up a bunch of these smaller competitors, again, at prices that perhaps people think is expensive, but are they getting ahead of some of the technology that will become the hot new thing later on?
I just don't remember them making the complaints at the time. And shouldn't a CEO be rewarded for making making a really good judgment about the future and anticipating where things are going and buying things ahead of time for that reason. Shouldn't they be rewarded for that?
Some people would claim that the antitrust unit really turned a blind eye early on and wasn't that aggressive in getting in and raising some of these questions at that point. So price is one thing.
Sure.
Sucking up a number of competitors is quite another.
And I'm not here to lobby for Meta. Let's be clear
I was about to say,
that.
who are you?
Yeah. Let's be clear about that. Futures right now on the S&P positive 0.5%. Looking ahead to next week, it's Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, let's start with the Federal Reserve. It seems to me that at the moment we're focused on the way the chairman frames risk management, whether there is a focus on over-tightening or under-tightening in 2023. What do you think the biggest risk is for this Federal Reserve?
I think the biggest risk is if they under-tighten, because they've sent such a strong message about needing to get inflation down before they make any other changes, that that's the number one priority. I think they have to continue to send that message. The risk is, though, that they probably will over-tighten and, we'll get a recession and things will break down, but I don't think that they can afford to not continue to send that message.
Kathy, how does that inform your view of whether to go long some of these longer duration bonds, 10-year, 30-year notes, versus perhaps pare back, especially after the enthusiasm we've seen of late?
Yeah, Lisa, we were pretty enthusiastic a while back about when the 10-year yields hit 4% plus. We were pretty enthusiastic about extending duration. We still like extending duration on rallies or on increases in yield. Going forward, but I think we're going to have kind of a rough ride here over the near term because so much good news has been priced into the market. But our long-term view is that 10-year yields can fall as far as 3% this coming year. So we will use those kind of moves up in yield to extend duration.
Kathy, you said that the biggest risk is under-tightening, not over-tightening. How much do you get pushback? Is this basically not the consensus anymore as people believe in this disinflationary story that will pick up steam throughout 2023?
Well, we're in the disinflation camp. I think the problem is that because of the lags that are involved, it will take time to feed its way through. And the market, when I look at the shorter end of the market, it's already discounted, re-rated what the Fed's going to do. And given that financial conditions haven't tightened or as much, or they've loosened over the last couple of months, I think that the risk is that the Fed has to push back against that. And if they don't over-tighten, then we're going to see inflation kind of bounce back again at the end of next year.
So, Kathy, can we put some numbers on this? The Federal Reserve, in their last projections from September, they get updated next week, of course, had PCE, core PCE at 3.1% at the end of 23, 2.3% at 24. Let's park 24, because I think 23 is hard enough. Where are you for 2023? They're at 3.1.
Yeah, I think we can get close to the 3.5 area. It depends really on wage growth and how quickly that starts to decline. We're starting to see some hints that it's declining, but not as much as anticipated, I think, at this stage of the cycle. So we'll probably have to push that out and say about 3.5 at the end of next year.
So just to be super clear, that glide path to 3.5, does that include a recession to get there?
Probably, yeah. Well, we think risk of recession is very high. The indicators from the inverted yield curve to the leading indicators. I mean, I could go a long list here of things that are rolling over, housing, et cetera. We do think a recession is pretty high risk.
So this is important because I'm really interested in how you interpret their reaction function. If their gliding path is down to 3.1 and you think 3.5 year end next year, you've got a recession in the mix as well. Are they cutting in 23 in that world?
I think they could at the end of next year. I think it's reasonable that if we are in a distinctly clear recession and inflation is pretty close to 3.5 for PCE, they could at the end of next year. But again, I think the playbook here is the Volcker Fed. We've heard this over and over again, that Powell doesn't want to be the Arthur Burns of his generation. He wants to be the Volcker of his generation. So I think that they'll try to manage it to avoid a deep recession. But I think if the choice is recession versus inflation, the choice will be recession.
When history books look back, Kathy, do you think that they will agree with Harvard University professor Jeremy Stein, formerly on the Federal Reserve, who says that it is astonishing that we haven't seen a financial system blow up, that if you had said a couple of years ago that you would have had consecutive 75 basis point rate hikes, you would have said it would have been financial Armageddon. The fact that we haven't is testimony to what the Fed has done. Can we actually say that already?
Well, it may be a little too soon to say we won't have some blow up somewhere, but I would say the strength of the banking sector is really what's helped us out this time, and that's an outgrowth of all the regulations from the great financial crisis. Where we look for potential problems is in private markets, and we've talked about this for months now, because of the buildup of debt in the private credit area. That's where we would look for problems to emerge, simply because there's lack of liquidity, a huge amount of leverage, and that's where the deterioration in lending standards really took place.
Kathy Jones, great to catch up as always. Of Charles Schwab looking ahead to next week on the Federal Reserve, and Bramo, seemingly the rate cut conversation still in the mix in a way that the Fed does not want us to be having that conversation. When I spoke to Cassie Barrow of JP Morgan yesterday, we were discussing what's more important here, the next 100 basis points of hikes or the cuts that everyone's pricing in afterwards.
I think most people would say the cuts, and I'm looking right now at the expectations in Fed funds futures, and you could see that you get to a peak of around 5% come in May, and then by the end of the year, you're back down to 4.3%. So that's cuts being baked into market expectations, which is the reason why it'll be such a blissful second half of people just piling in to heading back to the same old, same old. Again, this idea that we're in a rapid disinflationary period, we got rid of transitory, what replaces it looks a little similar.
Just to pick up on something you said about the fact we've avoided a financial crisis and all of that kind of stuff. I'm not saying we're going to get one. I'm just saying that it's been 9 months of tightening. It's been 9 months of tightening.
Every single FX strategist who's come on mentions the housing market.
Yeah.
And we're not going to see another 2008 style crash because there isn't the same type of leverage. The expectation for the declines that we could see range up to 20 to 25%, which is akin to what you saw in the 2008 to 2012 period. How does it affect people's sentiment, their spending power, their mobility, their ability to go find a job at a time when people are going back to an office? These are all considerations that make it very hard to fit into a tidy narrative that we keep hearing about next year.
Why do we always benchmark to 08? Why do we have to lead with that? It's not going to be 08. I mean, okay, it's not going to be 08, but why is that the appropriate benchmark? It's like I remember when tech stocks were overvalued and people would say it's not 99, 2000. Okay, but that's not a good benchmark for saying something's worth something by picking the most extreme point, maybe in post-war history of valuations, and saying it's not that.
Arguably, a very extreme point of dislocation might be something desired right now to clear out everything and then get back to what we had been before, where suddenly central banks can come back to the rescue. The fear that we heard from Freya Beamish was that we aren't going to get that, and it's going to be a more difficult road.
Look, the Fed's talking about long and variable lags, right? We can all agree that's true. So we'll wait and see. We'll see what the damage is off the back of all of this. It's been 9 months of tightening.
Couldn't agree more.
9 months, and they still talk about doing QT into 23.
Yep.
Equities up from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. FTX founder Sam Bankman-Fried says he's willing to testify on Capitol Hill next week about his failed crypto exchange. In a tweet today, Bankman-Fried said he doesn't have access to much of his data, so there's a limit as to what he will be able to say. The House Financial Services Committee had asked him to testify next Tuesday. Traders are awaiting inflation figures that may give them an idea on whether the Fed will be able to ratchet down its rate hike campaign. The U.S. Producer Price Index comes out at 8:30 New York time. It's one of the final pieces of data Fed policymakers will see before their meeting next week. The U.S. is sending another $275 million in military aid to Ukraine. It includes ammunition for the rocket system known as HIMARS, along with high-tech systems that can detect and counter drones. The amount is smaller than recent packages the U.S. has sent. Military officials are predicting a slowdown in fighting between Ukraine and Russia over the winter. More cost overruns on the Lockheed Martin F-35 fighter jet. Now, the Pentagon's most expensive weapon system, it will cost another $236 million to upgrade the plane's cockpit computer. That almost doubles the size of the original contract. Still, it's a small overrun compared to the overall cost of the F-35 program. It edged up last year from $398 billion to $412 billion. And Bloomberg's learned that Tesla will suspend output in stages at its Shanghai factory later this month. The suspension will last until early January. Tesla is upgrading its production lines and also faces slowing consumer demand. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
There's definitely awareness that the United States is no longer Saudi Arabia's most important economic relationship. Now they've got a really important economic relationship with China, and that's the message here.
Ellen Wald, fantastic as always, brilliant from the Atlantic Council, senior fellow over there. This from Barry Knapp of Ironsides just moments ago. It's a really interesting quote, Lisa. The question is whether it is 80, 81, 82 or 70 relative to 73, 75. Those were inflation recessions. 91, 01, 08 were credit crunches. Interesting perspective there from Barry on what the appropriate benchmark is when we're looking at how this is going to play out in the next 12 months.
It speaks to exactly what you were talking about. We compare it, we benchmark it to 2008, a credit crisis that was quick, that was short in terms of how quickly people could fuel it with monetary financing. At the same time, a 70s kind of feel is a real economy. It's a slower burn. It's a harder thing to get through. And that's what we heard from Freya Beamish.
How long does it stick through 23 and maybe even beyond? That's kind of the big question for next year, right?
I'm going to get so accused of being gloomy. I think it's going to be great. I think that everything's going to resolve itself, and we're just going to have a
That's what you
really
actually believe?
No, that's not. But I would like to believe that.
Okay.
I realize I'm sounding very gloomy.
Most people would like to.
And I'm going to just, I mean, honestly, Freya Beamish saying that basically people push back against gloom. It's true. Nobody wants to have that feeling. There's good under the hood. It's just that it's not going back necessarily to what we've known.
What did she say the chairman power was now? Cakeism.
Yes. To have your cake and eat it too. That you're going to cater to both the doves and the hawks because they understand everything and they're going to do it right and they're going to navigate this perfectly, and the market's along for the ride.
Okay, cool. Equities right now up 0.5%. In about 42 minutes time, you'll get PPI data in America, the appetizer before CPI next week. Crude looks a little something like this. WTI, $72 a barrel. We're positive 0.8%. We are up on the day. Lisa, we are down on the year.
I can't get over this story. We had been talking about $100 crude being in the very near future, China reopening. what are we doing? Why is oil so low? People are saying that it's just simply a lack of demand. Are people driving less? Are they flying less? Are they doing less? Is that really what we're seeing?
Let's have that conversation now with Regina Mayer, Global Head of Energy at KPMG. Regina, let's start there. Why is crude now down year to date?
Well, in contrast to your gloomy sense, Lisa, actually, supply is building. So that's the good news. Over the last quarter, we have had 1 million barrels per day of supply exceeding demand. And even though we're getting into the really cold months of winter, I'm here in London and it's freezing, the gas stockpiles were rebuilt and we have less demand and we still have supply. China not coming out of COVID the way it was predicted, perhaps in September, and that'll be a slower ramp up and we'll have more supply to deal with. So I think it's a more balanced sort of Goldilocks situation in the crude markets, not too hot, not too cold, just right for now, long may it last.
So it's a supply issue, not a demand issue. Is that what you're saying, Regina?
Well, we've been able to rebuild supply. So, we were really worried about supply because we had cut production during 2020, during the pandemic. We thought we had seen peak demand, if you remember that phrase from 2019 was peak demand, and it came roaring back as the world started moving around. And demand outpaced supply pretty substantially, and that drove triple-digit prices. Now the market's equaling out. We've been able to increase production. You've got OPEC close to back to where they were, and you've got the U.S. coming online. You've got Venezuela turning on. So more sources of supply are coming into the market, and that's offsetting demand. And we haven't seen the demand growth that we expected with China coming back. I predict we'll see it in Q1, Q2 of next year, but by then I think some of the supply situations and the shortfalls will have eased themselves out.
Can we talk about the China piece of this? Goldman just came out with a note. They said, don't expect a full reopening of China's economy soon, that growth in China could remain weak over the next 6 months. And Regina, I'll share a quote with you from them. The fundamental challenge faced by the policymakers is the rising economic cost of maintaining their zero COVID policy, while the vaccination rate for elderly citizens is still low. That last point, Regina, raises questions about how tidy, how clean, how smooth this reopening process will be in China, and whether they face the stop-start that we did in the West when we tried to do the same thing. What do you think the path looks like for China reopening, and ultimately what it means for crude and commodities?
I think that's exactly right. It will be a stop-start, which is also why I'm not predicting really high spikes in crude price. I think it's going to be very, very hard to get the whole economy moving again in China. And people may be reluctant to. There'll be some people that'll want to get out and will start flying as soon as they possibly can, and others that will be more cautious because of aging societies and some of the challenges that they have within their own demographic. So I'm not expecting a tsunami return. I think it will be stop-start, and I agree with the point that it could be weak through the next 6 months.
Lisa, this quote from Goldman: the combination of rising cases, some regions loosening policies, the winter flu season, the upcoming Lunar New Year, when hundreds of millions of people typically travel, makes it difficult to predict how cases, COVID restrictions and mobility may evolve in the coming months. And these are all the questions we've got to ask going into 23.
People suggesting that China's economy could actually slow further as they try to reopen, not necessarily come back in some sort of massive rebound. Regina, how much are you counting on that, though, especially when it comes to European natural gas prices, given that, stockpiles have been rebuilt now, but can they be sustained given that there isn't a solid source for that natural gas, and China will be a massive competitor?
Well, what I find is really interesting is how quickly the European continent has pivoted to U.S. natural gas and other sources of supply outside of Russia. 2/3 of the U.S.'s LNG exports are now going to go to Europe. And we're seeing a lot less Russian gas come through the pipelines. Norway is providing a whole lot more of that gas. And I think 6 months ago, I would not have been able to have predicted how quickly things have turned, and even how quickly the Europeans have built some of the infrastructure. There's that great story of how quickly some of the Germans built an LNG import terminal to get access to other sources of supply.
So have we seen peak prices? I mean, is this basically it? We're going to see a range that goes between 70 and 80, and natural gas is going to just stay where it is for a bit longer?
I can never say, I would never say this is it. I do think it's a really nice sweet spot, and because we're going into the really cold winter months, I really do hope it lasts. But you can never predict. There could be some hiccup somewhere in the world, and we it could be right back to where the spikes are. I honestly do believe this is where the prices were meant to be. I had been calling 70s for Brent and WTI. I never really understood why it got as close to triple digit as it did. So I do think some of the irrational exuberance has come out of the market as well.
Regina, was OPEC right to do what they did a couple of months ago?
Well, they're saying that they called it right. The OPEC thing was a little bit more symbolic, though, Jonathan. Let's be real, right? They were already producing under their quotas. So by saying that they were going to cut by 2 million barrels per day, they were already down 50% of that number. So I saw that as more of a symbolic move.
Regina Mayer of KPMG. Regina, always wonderful to hear from you on this energy market. Looking for the 70s, got the 70s. One of a handful of people that were looking for that, Lisa, because many others were looking for triple-digit crude well into 23.
What happened to the structural underinvestment in fossil fuels?
I know.
I'm kind of spinning my
Well, the
head
energy
here.
stocks are still ripping, aren't they?
Exactly.
Year
And
to
people
date.
saying that they're going to invest in the real economy. You're seeing some, including Chevron, invest in capital development and possibly drilling more and possibly getting more oil. I'm just trying to understand, especially given that China's going to reopen, even if it's slow going, it will eventually lead to a greater amount of demand unless there's a recession. And I guess that's what people are pushing back against.
So I mentioned Marco a little bit earlier this morning, Marco Kolanovic at JP Morgan. If you're just tuning in, this is his call on the energy name. So this is what we've got, basically. Just compare crude year to date now to energy equities year to date. Simple thing to do. Energy equities up by more than 50% on the S&P 500, crude's lower on the year. Marco says this. Recently, an enormous gap has opened up between energy stocks and the price of energy commodities. With all being close to flat for the year and the energy segment up around 60%, we believe that there is a tactical trade to sell energy stocks. His trade that he put out there late yesterday.
What if this gap makes sense? What if people have been underinvested in energy stocks
Some people would say the same
for
thing.
a decade, and suddenly the ESG considerations are changing in light of changing facts, and people are going back into energy, and they're saying this is going to be the area that's going to do better in an inflationary environment. And so even if oil prices go down, they're still going to need to get exposure to some of these equities. I mean, that's sort of the story that could explain a gap that could be more persistent.
I know there's a windfall tax element in the European economy as well, but the majors in Europe, as part of that ESG story, have underperformed the majors in the US, and they're pointing to exactly what you're talking about.
Which is why a number of investors are saying, let's go to Europe and buy some oil majors. So we are seeing that. I also wonder how this is going to play into the inflation story, because it's a lot cheaper to fill up your car, and then people can take that money and use it in the economy elsewhere.
Did Anne-Marie say that Ron Klain was ready to go from the White House because gas prices have come down? It's like mission accomplished.
I mean, let's see if they back that up with buying for the Strategic Petroleum Reserve.
And they're still selling from it, aren't they?
Exactly. Yeah, ongoing releases from the Strategic Petroleum Reserve.
Equities up 0.5%. Tracy McMillan, head of global asset allocation strategy at Wells. Up next.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Lisa, you you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Are in. And I think we're starting a new bull market.
I don't think investors are taking seriously enough the slowdown that we can have, and they're not also looking through it.
Longer-term inflation is going to be above the 2% that the Fed is targeting.
I still think Fed policy is going to dominate.
They still need to sound a bit hawkish. They don't want to scare the markets, but they do need to lift rates at least to 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Jim Paulson, the lows are in. I listened back to that yesterday afternoon.
Yeah.
Just unreal. The lows are in. Everyone's talking about a recession, and he thinks it's the start of a bull market again.
Well, and not just anywhere, but to 5,000 within 12 months, a 20% rally by year end of next year. So
yeah.
Let's get going.
I'll go back over the transcript again Sunday evening as we start a new week, looking ahead to CPI and the Federal Reserve. From New York City this morning, good morning, good morning. Equities right now trying to finish the week on a bit of a high. Futures right now, Bramo, up 0.6%.
Do you get anything from the week's trading activity? I mean, what's been the biggest story for you this week so far?
Maybe the very beginning of the week, ISM, upside surprise. More data on top of payrolls last week. Upside surprise.
Messy data and China possibly reopening, but it will be messy. The muddle through, so basically confirm your bias. And that has been sort of the story that we've been seeing. And really, that's the reason why nuance is a very hard thing for Jay Powell to show, because people will read it however they want to read it. And that has been my takeaway this week.
And doubling down on the consensus as well. I think we've heard more and more about it. Jim Paulson to one side. It's dip and rip through 2023. The first half's a dip, the second half's a rip. The Federal Reserve is going to pause. And then people think it's going to cut.
Did you come up with that? Dip and rip?
Dip and rip is my word for
I really like that.
For next
Dip
year.
and
That's
rip.
my phrase. Thank you.
That's going to be the 2023 mantra.
That's in my outlooks. It's just not been published yet.
With rip and dip, and then cakeism is going to just transpire into a perfect scenario for the year end. This is going to be one of the more interesting years. What is the counter consensus? And I keep going back to, if we don't get recession, that might be
if it gets pushed out,
difficult thing for risk assets to deal with next year.
Futures right now positive, just to whip through things. In about 28 minutes time, you get PPI in the United States of America, kind of the appetizer going into CPI next week. So PPI this morning in about 28 minutes, then it's on to CPI next week, Federal Reserve decision, the ECB, the BOE, all in the mix next week. Futures up, yields down by 2 basis points, 346, let's call it 346, 346.15 in the FX market, euro dollar unchanged, Lisa, 105.54. I'm itching to call it year over, which is why I'm saying year is over. when the Federal Reserve decides on Wednesday.
This is where I was going to go.
And then we all go away and watch the World Cup semi-final because Chairman Powell is counter-programming with the World Cup, which I'm not happy about. But anyway, we'll put that to one side too.
We all know this.
But we've still got central bank decisions to come on Thursday, the day after.
Well, and that's what I was going to ask you. Do you think that it matters, the ECB and how they deal with this? Or is it basically going to be, don't trust anything they say, just sort of go with what they do and come up with your own projections?
Naturally, on Wall Street, there is a home bias, and I totally understand why. So with the focus on the Fed and we move on with life, Europe's in a really, really tough spot. I think in a really tough spot that goes beyond, say, 12 months. And that's something that I don't think America faces in quite the same way. We're talking about an economy here in America that has to adjust to 500 basis points worth of tightening, the variable lags of that. Will we get a recession? How deep will it be? Europe is facing potentially a multi-winter crisis around energy. That's going to be a big, big effort for them next year. And the good news, and I think it's fantastic news, that we had a mild winter so far, that cold snap's kicking in, and I'll talk to Tadeo about that a little bit later this morning. But ultimately, winter's here. Can we repeat the act of getting up storage in the way we did this year, next year? I've asked it a million times. Many people are asking it as well. And I know it sounds boring because we keep going over the same ground, but I think it's an important question for next year.
Let's take it a step further. Can Germany remain an industrial superpower, an industrial powerhouse that really fuels the entire European economy if there isn't a more reliable source of energy that can actually cheapen some of the manufacturing costs that they're facing right now? And how much does that shift the overall outlook for the Eurozone as well?
The Mercedes CEO coming up in about 10 minutes' time. That conversation with Matt Miller just around the corner. Joining us now is Tracy McMillan, the head of global asset allocation strategy at Wells Fargo Investment Institute. Tracy, wonderful to hear from you. Bonds are back. I've got that on echo rattling around in my brain. You agree? Bonds are back for 23.
We do agree with that. We actually think that because we've seen now 2 years of negative bond returns, and we haven't seen that since 1958, 1959. We've never seen 3 years of negative bond returns. So we think that that sets us up nicely for 2023 for bonds. And we're suggesting that investors invest in the short end for some optionality. You know, if we do move lower in the equity markets, those shorter end bonds could provide some cash to invest in other asset classes, and also for income investors in particular, locking in some of those higher yields out further on the curve.
Do you believe in the John Farrow rip and dip scenario for next year?
Yeah, actually we do. It's dip and then rip, I believe, is the way we have it phased there. But yes, we think that next year what we're going to see is a Fed that's continuing to tighten, and that will eventually push us into a recession. And then once we kind of get through the tightening cycle, and we move into a recession, we think the Fed will eventually have to start cutting, probably by the end of next year. Markets will anticipate that, and they should move higher by the end of next year.
Dip and rip, that is the sequence.
Just to be clear, yes. That's not my call. It's just the way I'm framing what everyone has to say. I don't want to be part
You're
of
going
this.
to get a lot of messages.
Don't involve me in the 23
John Farrow
hours.
has cornered the dip and rip market.
No,
I
want nothing to do with it.
All right, aside from John Farrow backpedaling away from the phrase that he coined and the scenario that a lot of people agree with may happen next year, how much is this predicated on the idea that we're going to head back to a low inflation kind of environment, that basically we're going to go back to what we came from, not necessarily a newly inflationary environment?
Yeah, that's really key, Lisa. The inflationary environment this year has certainly driven markets and driven them lower so far this year, because the inflationary environment has impacted monetary policy so much. Going into next year, we do think that we're going to continue to see housing weak, we're going to see goods weak, and we need to see services and labor also continuing to weaken, eventually tipping us into recession, bringing inflation lower, and that's when we think the Fed can start to cut rates. We see inflation, probably 2.5% to 3% by the end of next year.
When it comes to equity risk, do you have a geographic bias going into next year? What is it?
We do. Yeah, we do. We've had that geographic bias all year, and it's U.S. over international. We continue to think that U.S. companies are going to have relatively easier time generating better earnings. We think that within the international space, what we're seeing there, as you mentioned, developed markets are having a very difficult time of it, particularly Europe with the war in Europe, not only the energy crisis that you spoke of, and emerging markets. We really have not seen a U.S. recession without pain being felt in the emerging economies. So we continue to favor U.S. for those reasons.
Tracy, wonderful to hear from you. Tracy McMillan there of Wells Fargo Investment Institute. Thank you. You heard it there, didn't you? The biases towards the United States. And I've heard, actually, if you talk to people like, let's say Invesco's Alessio De Longis, he joined us earlier this week. He thinks this is a recovery trade. He's overweight equities, more so than he was recently going into next year. He likes abroad. I hear more about EM, things like that, perhaps off the back of what we're seeing play out in China, but ultimately there seems to be a little bit more hunger, I think, appetite for going abroad based on the better news we've seen so far.
And do we see that continue, and can it be sustained at a time when, again, how much demand is there going to be for natural gas, especially with China reopening, for copper? And then what does it do to markets that are more fragile? There are a lot of people who say we're not out of the woods, and I know that Damian Sassower, who covers emerging markets here, talks about the incredible amount of debt to GDP still there. So again, it's too soon to say, okay, all clear, but the bias right now is toward risk and toward areas that haven't been inflated as much as where we are seeing in the U.S.
The China reopening is a feature here. I understand that. And to go back to the Damian conversation, we asked him delicately, there's a difference here, isn't there? A one-way street, a one-way road towards a full reopening in China, or just a little shift to appease some of the protests that took place a couple of weekends ago. Which is it? And when you ask people in EM, I think they're still in camp 2 and not quite in camp 1 just yet. And even if you are in the first camp and not the second one, and you believe this is a one-way road to reopening, maybe that's the intention. That might be the objective. Is it achievable, given the experience that we had in the West when we tried to reopen? And this is something we keep going back over. Yes, we're seeing these curbs, these restrictions get adjusted, ease from city to city across the country. But if you get a surge of infections and mobility starts to become more problematic, do you start to see things shut down again? And remember, in the West, I remember this, Lisa, it wasn't just the restrictions. People were choosing to stay away from certain situations.
Right, that's what they're worried about.
You remember what happened last Christmas 12 months ago? Omicron. All this stuff sounds so foreign now, right? That was the thing we were obsessed about 12 months ago.
Then.
We had all the cancellations at the hotels and the restaurants in places like London before the restrictions even kicked in.
I know, except now people think, okay, if I get it, whatever. I guess
it's a change of attitude.
A good time with my friends and family, and I wonder how long it's going to take to get to that point. But I take your point here that there's going to be a rocky road for China. You can't be a little pregnant. You can't be a little open. You have to be either all or none. And when you are all, it means that people have to be getting infected at a time when there isn't necessarily that herd immunity, and it's leading to a lot of concerns.
When was the last time you said the word Omicron? As it came out of my mouth there, I just thought, God, that feels like years ago.
That was December and January, and just on brand, I did get Omicron then, and I remember I was really happy. Not that I was happy, but I was happy to get it over with, because there was this feeling of an inevitability that everyone was going to get it. And, you get to, did you see that Saturday Night Live sketch about
getting COVID?
Yeah.
Yeah, I did, and then I got it.
Yeah.
I was like, it's not quite that.
Side effects of COVID
Do you know how on brand that was for you, that you got it and you were happy?
Well, I wasn't happy.
Do you know how on brand that is?
It was like you getting it over with. It was a slow time of year. It was like, you're going to have it. And I guess when you're reopening, you just have to assume. It's pretty infectious.
You're gloomy about absolutely everything, and then you get COVID and you're happy.
I wasn't happy to have COVID. It was just, get it over with.
We're looking to China and trying to work out what's going on.
You don't think that that's at all?
Can I just do the news just briefly? Tesla will suspend output in stages at its Shanghai electric car factory, according to our reporting. We want to find out what's going on over there, and we're going to do that with the Mercedes CEO, Ola Kalenius, in just a moment. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. FTX founder Sam Bankman-Fried says he's willing to testify on Capitol Hill next week about his failed crypto exchange. In a tweet today, Bankman-Fried said he doesn't have access to much of his data, so there's a limit as to what he'll be able to say. The House Financial Services Committee had asked him to testify next Tuesday. A surprise from the Senate today. Arizona Senator Kyrsten Sinema is changing her affiliation from Democratic to Independent. That will make the Democrats' narrow majority more complicated. Sinema told Politico she will not caucus with Republicans and says she'll keep voting the way she's done her first 4 years in the Senate. Investors will be watching the release of the U.S. Producer Price Index for clues on what the Federal Reserve may do next. The numbers come out less than 20 minutes from now. The forecast for November says that inflation at the factory level fell from 8% to 7.2% over the previous 12 months. Fed policymakers will meet on interest rates next week. Bloomberg's learned that the U.S. is preparing more sanctions on Russia and China for what it calls human rights abuses. The sanctions against Russia are expected to focus on its efforts to get weapons from countries such as Iran, especially drones. The penalties against China will center on its fishing industry. And Microsoft says it will address concerns that the U.S. regulators have about its $69 billion takeover of Activision Blizzard. The Federal Trade Commission is seeking to block the deal. It says the tie-up between the Xbox maker and the popular video game publisher would hurt competition. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, on Tuesday morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report Tuesday morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
What we hear from the Federal Reserve is they're very resolved and resolute to make sure that inflation comes down. Even though we're seeing these disinflationary forces come into play, it's not enough yet to get us back towards the 2% target level with confidence. And I think that's what the Federal Reserve is saying. We really want to be confident we're back to 2%.
Kathy Bostjanczyk there, the nationwide chief economist, weighing in on the situation in America ahead of the Fed decision next week. Here's the price action for you. PPI data in about 13 minutes' time. Going into that, Treasury's unchanged. Your 10-year, 347.78. Euro dollar not doing much, 105.61. Equities elevated, up 0.5%. Matt Miller joins us in the studio. This is cool. Matt, we've got a couple of things to do. Need to work out what on earth is going on in Germany. Winter's arrived, I'm told, by Maria Tadeo. Need to work out what's going on in China as well, with the latest news out of the Shanghai factory and Tesla.
Yeah, absolutely. And I think it's also interesting to look at the tug of war between the possibility of reopening in China driving demand up globally, and higher rates around the world causing a recession that drives it down. We've seen that play in oil, and we have the honor of welcoming Ola Källenius in the studio, the CEO of Mercedes-Benz. I want to get you to weigh in on this because it's hugely important for your business as well. If they reopen, more drivers are out on the roads in China, and that's a big growth area for your business. Is that good, and is that good for 2023 for Mercedes, or are you more concerned about rates rising around the world causing recessions everywhere?
Good morning. Great to be with you this morning. You said it. China is the biggest car market in the world. In fact, if you look at the size of the Chinese market, it's actually bigger than if you put United States and EU together. So what happens in China matters for the auto industry and, of course, matters for Mercedes-Benz. We have now come through a period here in the fourth quarter where we have had some lockdowns, in some places actually extensive lockdowns, which shuts down dealers. And frankly speaking, if you're at home, you're not going to go to a dealer and buy a car. But at the same time, the central government has now clearly communicated that they want to ease up the situation. So what's going to happen? Are we going to see a stop and go, or are we going to see a gradual easing? It's difficult to say, but how that plays out will definitely define what the biggest market for us is going to do. But hiding beneath that has been generally a little bit weaker Chinese economy than we have been used to for the last years or decades. And I can now see that the central government is trying to put some stimulus into that and see if they can restart the economy together with opening up. So glass half full, 23 could get maybe better.
You know, the other thing about your company is that you're really working on a strategy to go back to a Mercedes-Benz of the past, where you make the luxury car that everybody wants, and you're focused on those higher margin products rather than trying to be everything to everyone, right? That coincides with pricing power that's tremendous, and a lack of inventory around the world. So the supply side has really been tighter because of supply chains. Can you keep that pricing power if we go into a recession? When all the chips come flooding back onto the market and everybody can sell as many cars as they want, can you keep from going back to the rebates and the full lots that we used to see?
Mercedes-Benz has always been a combination between, on the one hand, innovation and technology, but on the other hand, luxury, something special. When you get a Mercedes, it's almost like you reward yourself. And even before we got into this situation with chip shortages artificially keeping supply down, we had already pivoted our strategy towards being, let's say, more thoughtful in go-to-market, look at building stronger contribution margins, watching our pricing powers, don't do fleet deals that don't make sense. So that was something that we had started before this chip crisis. Now, it goes without saying that if you have higher demand, as has been the case for the last couple of years, and you're held back by supply, that provides for very, very, very strong pricing. If we now get into a situation next year where the economy cools down and we get back into an equilibrium, so it's demand that controls the sales volume as opposed to the chip supply, yes, of course, we got to stay disciplined. There's no doubt about it. We have done a lot of work on our break-even point to make sure that we can lower the break-even point in our plant so we're not forced to keep the plant running at a certain number. So we'll see what happens, but in general, it is our target to stay disciplined.
You mentioned your plants, and we've been hearing this morning about winter has come in Germany. Obviously, the gas issue is a difficult one for factories. You can't run a paint shop, right, without gas. You can't run your line without gas. What will you do if it comes down to rationing?
Well, after an unusually warm fall, indeed, it's now getting colder. But the task force to deal with this really started on February 25th in Germany. We had a scenario already at Mercedes-Benz. What if we get cut off? And we have been working on optionality and resilience. So if we look at before the war started, if our gas usage was index 100, we can go now to an index 50, so a reduction of 50% while maintaining production for Mercedes-Benz. How do we do that? Yes, efficiency is part of the equation. Yes, the government has suggested that in all buildings, temperatures are lowered. We do that as well. Wear a sweater. So efficiencies has been one part of the answer. Switching to electricity away from gas, but also in some cases switching from gas to oil, and oil is available. So there's been quite significant resilience package. in our company, but in Germany in general. So I think we are quite strong compared to where we were 9 or 10 months ago to go through this winter, but we're not out of the woods. So people have to work on efficiency, not just companies, private citizens as well.
We are in America, so let's talk about the Inflation Reduction Act just briefly. It's been criticized by European leaders. For you as the CEO of Mercedes, do you criticize it as well? Is this a good thing or a bad thing for Mercedes?
The underlying idea to support and accelerate decarbonization, I'm all for that. In fact, it is Mercedes' strategy to go all in on electric. We're going to put the company in a position by the end of this decade to have an all-electric lineup and be able to serve markets that are ready fully electric. So any policy that supports that, to start with, is a good thing. Now, there's another side of the coin here. We shouldn't do that while at the same time upend free trade. So one has to be mindful that over the last 30 years of globalization, why have we been able to grow economies as strongly as we have? It's been WTO-driven free trade. So if we take a step back on that and we create barriers again, that would be a bad thing. And in that case, I'm hopeful that between the EU and the United States, ways can be found to uphold free trade, but at the same time accelerate towards a carbon-free.
That's the hope, but you're not a policymaker, you're a CEO. Have you got to put more money to work here in America and invest more here and produce more here because of this?
Even before the Inflation Reduction Act, we had started that. We call it region for region strategy. So, of course, our three biggest economic or markets are the three big economic regions with Europe, United States, and China. So our vehicle production in general, but also the battery supply chain, and we have put $1 billion into our plant in Alabama and built a brand new battery factory that I opened myself earlier this year, in fact. So we had started that already. So
can we expect more?
That is happening. But what you can't do, especially if you're a premium luxury manufacturer, is you can't divide every single model into 3 pieces and make it in every region. It economically doesn't make sense. So we also rely on the ability to export, and we will see how that plays out.
You know, one thing that Americans have imported, Formula One.
Yes.
What have we got now? Miami,
finally.
Vegas, Austin. You must be happy about that. How cool is that Formula One has finally broken this country?
Formula One has grown tremendously over the last year. So I think Liberty, who owns Formula One management, has done a tremendous job, and we have helped them doing that by providing a very exciting show. United States
Does Mercedes do okay? Is Mercedes good at Formula One?
This year? Are you trolling our guest here? Are we gonna have a better car next year?
Well. We won one race, so there was redemption. But as in any sport, there's always next season.
You've got to give Lewis a better car. Come on, it was absurd this year.
That is our job. That is our job, and we're working on it.
Ola, this was great. Thanks for being with us.
Thank you.
Thank you. Live from New York City, this is Bloomberg.
says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance on radio and television from New York. Yesterday, we broke the 5-day losing streak for the S&P and the NASDAQ. Today, we are looking to build a little bit on those gains, but it is a very quiet market here as we await one of the key data points ahead of next week's Fed meeting. We are waiting for the PPI. We are seeing a little bit of a lift. S&P's futures up 0.5%. Here to really break down the data that really gives a sense of how much inflation is coming down is our very own Michael McKee. Mike.
Well, Lisa, we're just getting the numbers in here, and PPI, unfortunately, goes up on a month-over-month basis. 0.3. The forecast was for a 0.2 increase. Ex-food and energy, the core rate for PPI up 0.4, and that forecast is that was double the forecast of a 0.2 change. Final demand year over year, therefore, goes up to 7.4%. Actually, it's down 7.4 to 7.4% from 8%, and the core is at 6.2 from 6.7. We're in the land of base effects here, where inflation was high a year ago. So even though inflation on a month-over-month basis is a little bit higher, we're seeing inflation come down on a year-over-year basis, which should make people happy, I guess, if we don't understand all of it. Index for final demand goods was up 0.1%, but for services, I'm looking for the services number here. Energy was down 3.3%, but I'm not seeing services. Services here, 0.4%. So what we're seeing is services are driving the inflation picture in PPI as well as in CPI and PCE. That's the area of concern for the Fed, and that's what they're going to have to work on.
Upside surprise, and that's a bad thing. Good news is bad news right now in terms of the resilience of the economy. If you take a look at markets, 2-year yields moving higher here. We are seeing them hit that 4.3%. You saw NASDAQ took a deep dive. It's now down more than 0.6%. You see the same kind of move in the S&P futures. This is not surprising. You're seeing dollar strength. You're seeing yields higher across through the curve. This is exactly what we would expect. But Mike, how indicative is PPI? How important is this metric to really give a sense of the direction of CPI and the other metrics the Fed really looks at?
Not as important as it used to be. It used to be thought of as sort of a precursor, and these things would work their way into CPI, but they're essentially go in parallel now. So it's not a major clue. It does give you some idea of where we're going, but it isn't going to change a lot of people's thinking about what CPI will be next week. Now, one other number I want to mention here is within services. I said services is the big problem here. Trade services up 0.7%. That's basically retailers and wholesalers, and they measure that by looking at margins. So it tells you two things. The inflation problem at this point is in retail and wholesale more than anything else in the services category, but also that margins are holding up for retailers and wholesalers.
Which is exactly what people think will not happen at the beginning of next year, so we will see. Michael McKee, thank you. Stick around, please, and if as you parse through the data, as you get interesting nuggets, keep us posted, because this is more interesting to me, at least, from an underlying component perspective, perhaps, and even the headline perspective, to understand where the inflation is coming and how strong and persistently strong the services side of things really is. Joining us now is somebody who has been absolutely amazing on all things having to do with the U.S. economy, from her experience at Bank of America, now at MasterCard Economics Institute, where she is chief U.S. economist. Michelle Meyer joining us here in studio. Michelle, fabulous to have you with us. What's your take on these numbers?
Well, I think it's as Mike summarized. Clearly, there's still producer price inflation pressures, but you're seeing it different by category. So there's some relief in terms of some of the commodity price pressure. That was a big part of the story earlier in the year, but there's still that lingering pressure that's happening more on the services side. And that's something that's very, very clear on the consumer side, too. We'll presumably see that to some extent. It's CPI next week, this differential between core goods inflation, which is coming down in part because those producer prices are also coming down, but services inflation, which remains a lot stickier.
Does this data point to a recession in the U.S. in the first half next year?
I don't think so. I mean, one of the things that we've been pretty clear on is that we don't think a recession is inevitable by any means. I mean, I think, looking at the data that we are examining on a regular basis, the consumer has purchasing power. They've had purchasing power throughout the year. And I think people underestimated the resolve of the U.S. consumer to spend, the desire to spend, and the ability to spend. And that's still here.
Okay, so you moved to the suburbs. You understand this. Everybody drives around, and when you have to fill up your car and you actually get a lower price, you generally have more money in your account. So how much is the decline in gasoline prices perversely going to fuel ongoing inflation for longer than people previously expected?
Well, I might not be the best person to answer that because we moved electric, but
sorry, carry on.
In general, that's exactly right, which is that, it's something that's tangible, and it's not just gasoline, it's also food as well. That's a big part of the story, which is you walk into a grocery store, you buy, kind of the same type of items every week, and you see those price differentials. So there's still those dynamics, these kind of cross currents. On the one hand, quite a lot of nice relief from lower gas prices. On the other hand, food price inflation remains high and problematic.
So
interestingly enough, we do have a number here. Gasoline price index fell 6% in the PPI in November. So a significant decline there, which of course the Biden administration has been waving like a flag recently to get people to figure that out. But final demand goods, 38.1% in the index for fresh and dry vegetables. So food prices are still going up.
Yeah, and people can feel that when they go to the grocery stores, and it's definitely impeding pricing power there. But all of this is really confusing. It's a muddle, and that's the reason why people believe in this recession, and yet it doesn't seem to be feeding into this data. Do you buy into this massive disinflationary kind of feel that people are basically pricing into the dip and rip scenario that John was talking about?
So one thing that we've seen in our data is that in this holiday shopping season, consumers are more promotional based than we've seen certainly in the last two holiday seasons. So when we look at our daily data, we saw, a bit of a softening at the end of October, early November, and then this big surge of activity into the Black Friday period, particularly for things like apparel, which was really, really strong. So I think consumers are being targeted. They're being, cognizant of how they're spending, where they're spending, what they're spending on, and relative inflation is playing a role. Relative interest rates are playing a role. So there's, a consumer that's aware of these headwinds that they've been facing throughout the year, and they're navigating it. But I think they've navigated it a whole lot better than people had given them credit for.
Right now, we're looking at a potential for the Fed getting a soft landing, just like they said. What does that mean in terms of how high rates should go?
Well, it seems very clear they're not done hiking. So in the upcoming meeting next week, the expectations for another 50 basis point have hikes, which makes sense. That is a slowdown in the cadence of hikes. So they're clearly starting to see some signs that their monetary policy hikes, that it's transmitting into the economy. It's making a difference obviously in the housing market it is. In some of the good sectors, you're seeing those ramifications as well. But I think that the next step after this will be that the Fed continues to move up, but they do so a little bit slower. They're trying to monitor how the economy is reacting to those hikes. And they are seeing dynamics in the inflation data that also is presumably encouraging, right? The fact that core goods is coming down. We'll see what OER does next week. That's going to be really important as well.
Meanwhile, people are still pricing in rate cuts, Mike.
Well, some people in the markets are, but it's interesting. Bloomberg has just done a survey of economists, and the majority of economists think that the Fed will now go to 5%, but they also think that the Fed will keep it at 5% for the entire year, which is a little bit different than what you're getting in the futures markets. So we'll see if those two converge.
You know, and then a lot of people think that whatever the Fed does is going to be enough to bring us back down to where we were before. Do you buy that?
Yeah. So, you know, one of the things that we just published our economic 2023 piece this week, and one of the themes there is this idea of a rebalancing or a normalization. So part of what's happening still in the economy next year, which the Fed is trying to engineer, is a normalization of parts of the economy that we're in excess. So think about the labor market. Should you have all these job openings relative to the number of unemployed? No, they want to cool that down. They want to normalize it. Some parts of the economy, they need to do more than normalizing, which is housing, where you've had a lot of excesses build that they want to try to correct for and prevent a bigger shock into the future. So I think it's this rebalancing that's been, you know, kind of desired throughout 2022, which is what the Fed was, you know, trying to achieve with higher interest rates. And 2023 is going to be a story of those outcomes in our view.
What's the outcome in housing? I know you've been terrific on this for years. Do you think that we're in for a pretty protracted and deep downturn in terms of prices?
I think housing is in for some real challenges ahead. I do, because when you look at how much affordability has changed, it's huge. It's been a big shock because home prices ran well above income for a period of time, which was facilitated by these extraordinarily low rates for the extended period, presumably too long, and that created this big imbalance. So we're already seeing home sales fall sharply. Home prices are starting to fall on a month-to-month basis, and it's particularly in some areas like San Francisco. It's fast. So I think there's more to come.
And just quickly here, is it going to be comparable to 2008 in terms of the scope of the declines?
I don't think it will, because you won't have the degree of REO, so you won't have that forced selling, which creates that heavy price discounting.
Michelle Meyer, thank you so much for being here, and have a wonderful holiday season. Michelle Meyer of the MasterCard Economics Institute. Always great to get that insight. Mike, final thoughts here when you take a look at the underlying data. It's just, again, another upside surprise at the wrong time.
It is, although a lot of it is in the food category and in the services categories that we knew were going to be printing higher. It'll be interesting to see, as Michelle said, how it translates into the CPI and whether services margins are still rising there. But food is not something the Fed can do something about, so it kind of has that externality. But we are also, as I mentioned, in base effect territory. So we're seeing the year over year go down, and that's what's going to matter to a lot of people. And that's what would shape inflation expectations.
Yeah. Michael McKee, thank you so much. I just want to bring you this. Vladimir Putin has been speaking, holding a news conference after a meeting with the Supreme Eurasian Economic Council in Bishkek, along with the leaders of Belarus, Armenia, Kazakhstan, and Kyrgyzstan. And he talked about how Russia may cut its output as part of the oil cap response. So this perhaps a possible response saying we're just going to supply less if you are going to pay us less. You are seeing oil prices pop a little bit further on the heels of that. Right now we're seeing West Texas Intermediate 72.82 as it does digest some of what we're seeing. Again, we'll see how this plays out with the oil cap going into effect. We're going to get a sense also of how we get the ramifications of the latest PPI data playing out in markets that have moved back from some of the deeper losses initially. But how much does this give a sense of inflation continuing to surprise the upside? If you get 5% Fed funds rate for a full year, how much does that go against what people are currently pricing in? The S&P futures down 0.4%, 39.50 dollar strength, euro 105.53 versus the dollar. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In a series of tweets today, FTX founder Sam Bankman-Fried says he's willing to testify on Tuesday. That's an apparent reference to an invitation to appear before a House panel to be questioned about the failure of his crypto exchange. But Bankman-Fried said he would be limited into what he could say because he doesn't have access to much of his data. The Democratic-led Senate has gotten a jolt. Arizona Senator Kyrsten Sinema registered as an independent today. And that comes just days after Democrats had gained a clean majority in the chamber. Her move won't affect the overall control of the Senate next year, but it could complicate the party's agenda. Sinema says she will not caucus with Republicans. The U.S. is sending another $275 million in military aid to Ukraine. It includes ammunition for the rocket system known as HIMARS, along with high-tech systems that can detect and counter drones. The amount is smaller than the other recent packages the U.S. has sent. Military officials are predicting a slowdown in fighting between Ukraine and Russia over the winter. India's Prime Minister Narendra Modi won't be holding an annual in-person summit with Vladimir Putin. Bloomberg's learned that it's because the Russian president threatened to use nuclear weapons in the war in Ukraine. A senior official says that the relationship between India and Russia remains strong, but highlighting the friendship may not be helpful for Modi. Now, some of the world's top investors are predicting double-digit stock gains in 2023. That would bring relief after global equities suffered their worst loss since 2008. 71% responding to a Bloomberg News survey expect stocks to rise. For those seeing gains, the average response was a 10% return. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
If you think the bear market is not over, I get that, and that's one thing. I think the lows are in, and I think we're starting a new bull market. If we avoid recession, which I still think the odds favor, maybe 60-40 that we do, or if we have a modest recession, that the stock market is into a new bull market.
A new bull market that might look like 5,000 by year end. That was Jim Paulson, Chief Investment Strategist at Luthold Group, speaking with us yesterday. A call that got a lot of attention because of how dissonant it was from the flat calls that people have all across Wall Street of 4,000 to 4,100. Chief among this question is how much inflation will roll over, how much the Fed will respond by perhaps dropping rates as soon as next next year. Ira Jersey has been pushing back against that for the better part of 2022. He joins us now, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, given the data we just got, given that PPI came in hotter than expected, given that this is stemming from services, how much conviction do you have in a Fed funds rate of 5 to 5.5% for next year?
Yeah, so very high, actually. I think that a 5.25 of the top end of the Fed's target range is very likely. Our economics team here at Bloomberg Economics has been calling for that for quite some time now, and I've come around to their way of thinking. In particular, because we've always thought that the glide path of inflation would be somewhat slower than what both the market and the economic consensus had been considering. And I think today's data just kind of confirms that view for us, that yes, inflation is going to come down, but it's going to come down more slowly than people had hoped. And when you have 0.3% PPI final demand, that just means that, hey, if companies can, they're probably going to continue to increase prices for the consumer a little bit, and that's going to maintain inflation higher than what the Fed wants.
One consensus going into next year has been that the long end, 10-year treasuries to 30-year treasuries will be a very valuable place to hold out. Do you think that's been overplayed? Do you think that perhaps they're a bit overbought at this point based on exactly what you're talking about, which is a stickier inflation that is resilient?
Yeah, I think they got a little bit oversold. People were short. It is a little hard to stay short bonds because the carry winds up being negative and you wind up having to pay the coupon. So as yields get even higher, it just becomes even more costly to be short the market. So I think we've seen a bit of a short covering rally here. What tends to happen in a rates market, and I think we're in the process of doing this, is we're going to find a bottom and then we're going to wind up staying in a range for a pretty long period of time. 2, 3, 4 months. And then the market, as it gets more information, as the Federal Reserve, we get toward the end of their hiking cycle, then the market will reevaluate what the next move is. So I think the long end, maybe I wouldn't necessarily say it's a screaming buy at this point. But at the same time, I also don't think we're going back up to 4.25%, 4.5% anytime soon either in the long end. It's the front end that's really interesting. And what you've seen since the PPI number came out is that the market was actually bull steepening. So the 2-year note was rallying a lot. That's completely unwound, and now you're actually seeing the yield curve rather flat on the day, whereas it had been 3 or 4 basis points steeper in terms of the 2-year versus the 10-year yield.
Ira, we're heading into an important week with the last Fed meeting of 2022. What are you expecting, not necessarily in terms of the decision and how much they hike rates, but in terms of the signaling and whether the balance of risks is perhaps more to the over-tightening than the under-tightening?
Yeah, so that's an excellent question, because what Jay Powell had said on November 30th when he was at the Brookings Institution confused the market a little bit. The tone was somewhat dovish, and the market certainly took it that way. So I suspect that Jay Powell will push back on that a little bit. Maybe talk more about what you guys had been mentioning. What you had mentioned earlier is that they intend on keeping interest rates at whatever the peak is for the whole year, even amid a little bit of an economic slowdown. So the reaction function, I think he has to take back a little bit of control of that, because the market certainly seems to think that there is a Fed put, and that if you start to see job losses, if we do have a mild recession like we expect in the second half of next year, that the Fed will start cutting early. So I think he'll keep on saying we don't want to cut too soon. We don't want to make the 1970s mistake of easing into a still reasonably inflationary environment.
Ira Jersey, thank you so
Hello,
much.
traders. How are you doing today? I'm going to place an order to sell short euro. The price I'm looking to sell 105.56. Okay. Order placed to sell short 105.56. If you're looking to sell euro, please follow this, copy this trade, and place an order. Okay. I'll speak to you later when we're going to get filled. Stay safe, guys.
This data, can that continue perhaps more than people expect heading into next year?
Well, what we've actually detected is margins are held up only because the energy sector is holding margins up, Lisa. So when you look at overall S&P 500 margins, operating margins and net income margins have been falling for much of this year relative to their peaks made at the tail end of last year. Analysts are expecting that to slow down, consistent with the idea that inflation in the form of PPI as well as CPI finally peaked over the summer and is likely to continue to slow. But is it slowing fast enough? And critically, is that comparison between PPI and CPI going to flip into positive territory? That's the critical question going forward. We need to see PPI decelerate faster relative to CPI as an indication that finally margins can hit their low when we exclude that critical energy sector from the S&P.
Do you believe this dip and rip story that we've been talking about all morning that John Farrow coined?
You know, our view, honestly, is similar to that you talked about with Jim Paulson. It does look like a sentiment washout occurred in the fall of this year. We talked about this a lot in sentiment in October and late September, really reaching trough levels. Our own proprietary market pulse index also indicated to us that we'd had a complete washout. The question really remains, okay, after the dip, do you really get that spark? And our annual outlook commentary would suggest we probably won't. The title of our outlook for 2023 is No Spark, No Fire for the S&P 500, because typically what happens to create that major up leg in the S&P and a source of optimism is the Fed reversal. And as we just heard from Ira, we're not likely to get a massive Fed reversal in 2023. If you don't have a Fed reversal, it's really difficult to argue that you get that big spark that lights a fire under the equity market into the tail end of the year.
Just quickly here, Gina, we were talking about how Vladimir Putin said that he may cut output of oil in response to the oil caps. And we've seen this divergence with oil prices low and equities in the energy space flying high. Do you think that gap needs to come closer, that either oil prices have to rise, and they are rising, they're at session highs right now following those comments, or that energy stocks need to fall?
So energy equities, especially in the S&P 500, are still trading at very, very low relative valuations compared to other sectors. So even though the prices have recovered, price recovery has not matched the earnings recovery in the energy space. So we would argue that the stocks generally didn't price oil prices when they were closer to $80 to $100. Instead, there's a tremendous amount of skepticism embedded in the overall valuations of the energy sector. This is one of the reasons why energy continues to lead our broader sector scorecards. It's been top 3 among sectors all year this year. It's still top 3, along with a few cyclical sectors and consumer staples. So it still is sitting in a leader position in our view, partially because valuations are simply not reflecting the reality that supply remains constrained for an extended period of time, and demand should hold in generally well amid those supply constraints.
Gina Martin Adams, thank you so much for being with us, as always. Just to bring you more details on this, Vladimir Putin, president of Russia, said it may cut its oil production in response to the G7 cap on the price of its crude. It said that a decision will be made in the next couple of days. We're talking about a $60 a barrel threshold on which Western nations would ensure the barrels being transported from Russia and floated around the world. The question is that currently that is the market price for Russian oil. So it's a question of whether that will actually affect their particular budget, but they are talking about possible retaliation. They're also saying that Russia will not sell its barrels to any country that sticks to the restrictions, though, reiterating that. So it raises a question of stranded oil, which has been a big issue for Russia at a time when Western nations are trying to tighten the screws in response to the conflict in Ukraine. We're also digesting the latest inflation data with PPI coming in hotter than expected, although decelerating, much as people had anticipated. Services so bright, but food also very much driving some of the increase, which is considered a temporary type of phenomenon. Right now, you're seeing losses being pared back in S&P futures, down just 0.3%, 39.53. Dollar strength continues, 105.42 on euro, and 10-year yields, 350 straight. From New York, this is Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
with unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Live from New York City this morning. Good morning, good morning. Equities fade just a little bit on the S&P 500 off the back of a hotter than expected PPI read. From New York, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Looking ahead to a defining week. Economists looking for inflation to fade. Chair Powell set to sign off on a smaller rate hike. And investors weighing whether this bear market rally has gone too far, too soon.
The market's getting very over-optimistic.
There's a little too much optimism embedded in markets.
We've seen this big rally.
This bear market rally in recent months.
We've rallied so hard off of those October lows.
Then you get a couple bad days like Monday and Tuesday.
They stuck you in probably at the wrong time. They whip you around from sector to sector.
I'm more on the side that there's too much pessimism.
And just when you think you got it figured out, there's another trick for you.
I worry that we still have downside.
You don't think that this bear market is over yet.
Joining us now to discuss is Citi Stuart Kaiser, Morgan Stanley's Jim Karen. Stuart, first to you. Do you think this rally can continue into year end?
Hey, good morning, Jonathan. Yeah, I mean, our view is you do have some upside into year-end at least. Early 2023 is obviously going to be a completely different story, but I think once you get past the inflation print next week and the FOMC assuming those, aren't way out of consensus, I do think there's some space to the upside. If you look at the degree of risk priced into those two events, it's basically 3 to 4 times the risk priced into any other day in December. So I think when you have that kind of risk premium priced into something, if you get through that in sort of a neutral or inline, type situation, then yeah, I think we can move higher into year end. And again, 2023 is a different discussion completely.
Well, given the risk you think exists in 23, the first question people ask is whether you think the juice is worth the squeeze. Clearly you do. When you say a bit of upside, Stu, how much?
I think you get back to that 40. I think you get up to 4,150, 4,200 in kind of an overshoot type scenario, but definitely back to 4,100 at least. And then at 4,150, I think is the number that, from our market technicals and sort of a CTA perspective, makes a lot of sense. It's a level that comes up in a lot of client conversations. So I think 4,150 would be the level we're looking for, with potential for a little bit of an overshoot if people get real excited about Christmas, et cetera.
Jim, I know you think there's a bit of a disconnect here. Treasury's rallying over the last couple of months, crude lower, much lower, sentiment better. Is that a disconnect that you think, Jim, needs to be reconciled somehow, and in which direction?
I think it is. I mean, you have 10-year Treasury yields moving a lot lower, and that generally doesn't give a good signal for positive risk sentiment that's in the market. That's usually a cautious type of a move. But look, I think a lot depends on, some of it depends on positioning, right? I don't think that we can look past the technicals. A lot of the reason why bond yields have moved down is because people have been underweight their duration benchmarks. Many index following investors have been short, and what they've been forced to do is cover. And despite what prices are doing, you're going to underperform your benchmark if you are not matching the duration. And I think many people were underweight their duration. So in some ways, I think that a lot of the narrative is really trying to fit a fundamental picture to what's happening to a technical price action. And there's a disconnect there. And I think that, look, if we get inflation that starts to come down, which I think it will, I mean, clearly we're going to see the pace at which that happens, I think that's going to be very critical. But ultimately, what it tells us is that the Fed is still likely to hike interest rates, 50 basis points in December, probably 50 in February, might do another 25 in March, get up to the 5 to 5.25% rate, but then they're going to hold off. And I think in that environment, bond yields can actually rise a little bit. And depending on what's going on with the demand in the global economy, oil prices look like they've come down quite a bit too, and may have some room to move a little higher.
So, Jim, can I pick up on something? Just the positive correlation between risk and treasuries. That's persisted through much of this year, on and off, but persisted through much of this year. Jim, do you think that can stick into 23 or not?
I think it does stick in the beginning stages. So I think that bond performance and equity performance are going to be relatively well correlated. So, for example, if bond yields are moving higher, it's more, in bond performance is coming down, it's very likely that we see a downturn in equity performance. But at some point, that correlation is not stable. Typically, these two asset classes have a negative correlation, meaning if bond performance is good, equities is bad, or if equity performance is good, bond performance is bad. And that creates the diversification. So essentially what I think happens is that longer term correlation, that negative correlation between the performance of stocks and bonds does reassert itself, but I think it's not going to be until after the Fed is done hiking interest rates. So that's probably not until the start of the second quarter of next year.
Stuart, where are you on that correlation between bonds and equities?
Yeah, I think from my perspective, the reason you've seen, bond yields lower and equities higher here is because bond yields are moving lower on the view that inflation has kind of peaked and is going to move down. I think to Jim's point, if you get into the first and second quarter of next year and bond yields are moving lower because recession risks are rising, that's sort of a bad reason for yields to be moving lower from an equity perspective. In that sense, I do think you could see the correlation shift. And frankly, that's exactly the way we've seen folks trading it on the option side, which is in the first half of next year, they're structuring hedges that benefit from yields lower, equities lower, i.e. protecting against kind of a hard landing recession outcome.
Stuart, out of interest then, what would be the pain trade in the first half, given current positioning, going into 23?
Well, I mean, given current positioning, I think if we're 4,100 entering the year, then the pain trade is going to be certainly lower in that sense. I look, the bear case that maybe you're trying to describe is you end up in a situation where leading indicators are deteriorating, and to Jim's point, the Fed is going to stay higher for longer. And in that case, the market's going to say, instead of this soft landing we were hoping for, the Fed is waiting to be, proved right on the inflation side. They remain tight, and I have to increase kind of my hard landing odds. So to me, that is the sort of, kind of worst case outcome. To the upside, sort of the opposite of all those things. But, anyway, I think that's sort of the bear case or the negative outcome you could have in the front of next year. And excuse me, very related to the bond equity discussion we just had.
Well, when it comes to the Federal Reserve next year, Jim, I think the question we've been asking over the last couple of days, and I had this conversation with Cassie Barrow of JP Morgan yesterday, is what's more important for me to focus on right now? What is it going into 23? Is it the next 100 basis points of rate hikes that this Fed is basically going to promise us next week? Or is it the rate cuts that this market is pricing in the back half of next year into 24?
Well, for me, the answer is very clear. It's really for the back half of next year. If those rate cuts that the market is pricing in do not come through, we are not priced for that. So essentially, what the market is saying is that the Fed is expected to start cutting rates in 2023. But here's another disconnect. The Fed is not saying that at all. The Fed is saying that they're going to keep rates high until the job is done, until inflation comes down. So it's really a question of when inflation comes down, which I think it will it stay down? The big risk, in my eyes, for 2023 is what if all of a sudden inflation doesn't stay low or doesn't stay down next year and starts to reaccelerate? Does that then bring the Fed back into their tightening cycle from an already higher base rate? This is something that the market is not pricing in, and this is what I'm worried about the most.
And Jim, I think this is a really important question, but it's not that straightforward. If they're not cutting in the second half, we've got to ask why and what the economic backdrop looks like. And you touched on it just there. Is it inflation persisting, and is growth still robust at the same time? Because, Jim, I think that's the key one for me. Let's say they're not cutting in the second half of 23. No cuts, they're sticking with it. CPI is still sticky. On board, I'm with you, okay. But where's growth in that world, Jim? Is growth soft or still firm? Because the market outcomes on that one, I think, are pretty different.
Yeah, and that's going to matter a lot for earnings and the like. So look, I mean, we could have a slowdown in growth, and that could certainly be, and that can certainly happen. Do we have a hard landing, meaning do we have a recession? Yet to be determined, right? It could be a not so hard landing or a softish landing. But if the Fed is not cutting interest rates in the second half of the year, it's probably because the labor market is still very, very tight and wage inflation is still very high. What the Fed is trying to avoid at all costs is a wage price spiral inflation, meaning that inflation starts to get so ingrained into people's thought process that it lets the inflation genie out of the bottle. It just keeps expectations moving higher and higher and higher. The Fed wants to avoid this at all costs. Powell has discussed this on many occasions. They will act aggressively to stop that. But we're not going to know any of this. We're not going to know any of this until next year, or until the third quarter, fourth quarter of next year, to see how low inflation has gotten to, and are the conditions such that inflation will stay low. And I'll say that over and over, that they'll stay low. So whether or not growth is up or down or slightly strong or slightly weak, I think is secondary for the Fed. I think they're willing to put us into a recession in order to stop the wage price spiral inflation risk.
So, Jim, the last 10 minutes is enough to make anyone run, hide under a rock, put a tin hat on, and stay in cash. Jim, what are you suggesting people do in the meantime going into 23?
Well, look, I mean, cash offers a yield these days, right? T-bills are above 4%. I think that's I don't think that's a bad place to be. That's not exactly, though, what I'm advocating. What I think that what we need to start to look at is really a balanced portfolio approach. Look, you've got equities that have dividend yields. You've got bonds. You've got investment-grade corporate bonds that yield above 5%. You've got opportunities that if we have even a not so hard landing, if we just have a mild recession, I think fixed income markets, and my average duration that I like to look at is about a 3-year duration, can still produce pretty good yields into 2023. So just putting your money in cash, I don't think is the optimal thing. We also have to capitalize on the fact that if there is a slowdown, bond yields may start to come down from some of these levels, and there's some price performance that you can get in there too.
Stuart, when it comes to market calls, what are you advocating for?
I think from our perspective, again, we're sort of bullish tactically into the end of the year. I think as you get into next year, clearly the chief risk indicator shifts from inflation to recession, and the need to, position your portfolio accordingly. I think, the areas we've seen the most interest from clients are obviously high quality stocks, stocks that don't have a lot of embedded credit risk, in case that recession is deeper than expected. And frankly, a lot of interest just in story stocks, a stock that has an idiosyncratic story that can be sort of an all-weather performer, even if inflation stays higher or the recession is deeper than expected. And, I think Jim made a really important point about inflation. And, right now everybody's focused on we're getting past the peak. But if that inflation starts to move sideways, somewhere in the fives, then, to Jim's point, the Fed is not going to tolerate that. And they're going to remain tight and even tighten further on the view that they need to get that down to a more acceptable level. So with those types of risks in the system, again, I think it's high quality stocks and stronger balance sheet stocks. The flows we've been seeing through our system, frankly, even during this rally, are hedge funds buying quality, buying large cap, and mutual funds doing very similar. So, despite the rally, I think the institutional community is still kind of being pretty cautious in terms of how they allocate for the medium term.
And if Jim's right and that risk materializes in the second half of next year, then that dip and rip consensus view for risk in 23, that's a massive challenge to that. Jim Caron, Stuart Kaiser sticking with us. Equities right now down a little bit by 0.4% on the S&P. About 45 minutes ago, PPI in America coming in a little bit hotter than expected. Equities lower. Yields just a bit higher, as you might expect, at a front end by a couple of basis points. 433 on a 10-year, up by 4 or 5 basis points to 353. Coming up on this program, an inflection point in China.
What's going to happen? Are we going to see a stop and go, or are we going to see a gradual easing?
That conversation up next.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
What's going to happen? Are we going to see a stop and go, or are we going to see a gradual easing? It's difficult to say, but how that plays out will definitely define what the biggest market for us is going to do. I can now see that the central government is trying to put some stimulus into that and see if they can restart the economy together with opening up.
China moving away from its long-held COVID-0 approach. A commentary on the Communist Party's flagship newspaper writing, we got through the most difficult moment in the battle with COVID. China has taken the initiative to adapt to changes. The tone shift coming just a couple of weeks after the paper reiterated that China will, quote, firmly implement the general policy of dynamic clearing. Chinese officials now mulling a 5% growth target for next year, and a team at JP Morgan saying it's achievable. They write the following: 23 will be the first year under the leadership of the new economic team. It will also be the transitional year for China's COVID policy shift. Economic growth may receive higher priority. Mike McKee has more. Morning, Mike.
Morning, John. The problem is here, there isn't unanimity on that view from JP Morgan. There's a lot of concern about what's going on in China. They do have to open up at some point, but here's what's happening right now. We're seeing cases skyrocket. And according to the latest figures that we have, we only have about 1% of Chinese people who are successfully inoculated and who have had the disease. So it can really keep spreading, and that's the fear as they start to open up. Bloomberg is expecting about 2 million deaths from COVID. So does that mean, as the Mercedes CEO said, a stop and go kind of performance? That's going to be the question. They're spinning it, certainly. The People's Daily saying, we've gotten through the most difficult moment. But then Gita Gopinath, the deputy managing director of the IMF, saying earlier this week that China's economic outlook has darkened noticeably, and the forecasts are not particularly good. The IMF cut China in October to 4.6 from 6%, and she said in January we'll be going lower. So they're not buying the 5% idea yet. ING and Goldman have warned that China reopening will be slow. They're not on board with that kind of growth rate. And the New York Fed's Global Supply Chain Index tightened in November with all those stealth lockdowns in China. So it does suggest that there's problems ahead, not only for China, but for the rest of the world.
Mike, you mentioned Goldman there. Can I just bring you that quote from Goldman? I'd love your thoughts on it. They said the following, quote, the combination of rising cases, some regions loosening policies, the winter flu season, and the upcoming Lunar New Year when hundreds of millions of people typically travel makes it difficult to predict how cases, COVID restrictions, and mobility may evolve in the coming months. And Mike, it does raise the question, at the best of times, it's hard to predict the future. How hard is it to predict Chinese growth next year?
It's the old saying, it's difficult to make predictions, especially about the future. It's very hard to do China because we saw the Chinese trade numbers come in poor this week, and we also saw PPI in China fall by 1.5% in the month of November, and that's generally a proxy for industrial production there. So we're not seeing good news out of China right now, and if we do see super spreading COVID events, it's only going to make things worse.
This raises questions about the commodity trade as well. Mike McKee, thank you, sir, as always. Crude is positive today, but on the year, it is negative. Investors weighing the impact of China reopening on oil demand as energy stocks have ripped this year and up by more than 50%. Big difference right now, what's happening with the commodity and what's happening with the equities. Take a listen to what Savita Subramaniam had to say.
Having some exposure to CapEx plays, to cyclicals in the form of energy, financials, to me makes a lot of sense because I don't see demand for energy going away and I don't see supply coming back online aggressively. It's starting to hurt being underweight energy. It's a big enough part of the benchmark. Oil could hit 150 next year. I mean, I think this is an environment where you don't want to be out of energy, and in fact, you want to be overweight energy.
Jim Kerr and Stuart Kaiser back with us. First to you, Stuart Kaiser, your thoughts on the energy patch right now, and if we can just compare and contrast what's happening with the underlying commodity and what's happening with the equity at the moment, it's pretty clear. One's breaking down and the other one is holding up. We've had massive gains this year. JP Morgan's Marko Kolanovic came out late yesterday and said the following: an enormous gap has opened up between energy stocks and the price of energy commodities. With crude being close to flat for the year, the energy segment's still up about 60%. We believe that there is a tactical trade to sell energy stocks. Stuart, your thoughts on that?
Look, I think it's important to separate the commodity from the equity, right? I mean, generally speaking, equity markets don't respond to the front of the oil curve. Most normally, those equities are going to trade off something like a 24-month oil future. So I do think you have to separate which part of the curve is moved versus which part equities respond to. And then secondly, you know, equities have both an earnings and a multiple, right? So coming into the year, energy was a deep value play, and values really benefited, as yields have risen. So some of that performance has less to do with the price of oil and a lot more to do with where valuation was and how styles and factors and things of that nature, have traded on a year-to-date basis. So, I think it's a tricky trade. I don't really have a strong view. I would say that a lot of folks, coming into the winter heating season, definitely expected oil to respond, much differently than it has. If I'm sitting here today, yeah, I mean, equities on the energy side do look a little rich relative to the price of oil, with the two caveats that I've mentioned before. But, you have the potential that you're going into a recession next year. So it's not completely surprising, to see those cyclical parts of the market, that, could respond negatively to that negative, kind of growth impulse. So, in terms of flows and what we've been seeing, yeah, I think folks have taken shots to the upside on China and certainly on energy to some extent as well. But I think you've been better off in the energy equities than you have been in the commodity. And that probably, at least, I think, continues for the near term.
Jim Caron, when it comes to the China reopening, I think over the last couple of years, we were all talking about a synchronized reopening. That did not happen. Jim, how unsynchronized will the global growth story be next year?
Yeah, I think this is a very, very key question. And I got to step back and take a look at the big picture, put my macro hat on, and ask myself the question, will China be in a better economic financial situation 6 months from now or not? And I would guess that they would be. I think the reopening will be bumpy, but over the next 6 months, they're going to do it. They have a directive to grow. It's a command economy. They're going to do it. Can I time it exactly what's going to happen in January and February in COVID cases and things like this? Absolutely not. But sometimes it's the change that matters the most. And if the change is in the right direction, whether they get to 5% growth or 4.6 or 4.5, that I think is good to know, but I don't think it's going to make a difference from an investment and from a trading perspective. What I need to look at right now, what we all need to figure out, is will it be higher? Will it be better than what it is today? And I'm going to make the bet that it will be. I'm not going to be able to time it, but I think directionally I'm going to be correct in that. And then all the things that go along with that, whether it's energy demand or global growth or positive for emerging market debt, for example, or even emerging market currencies, all of those things start to fall into place based on that view.
Hey, Jim, wonderful to get your thoughts. Jim Caron there, alongside Stuart Kaiser, the two of you. Brilliant, as always. Equity futures right now down about 0.4% on the S&P. As I said a little bit earlier, PPI came in just a little bit hot. Equities just a little bit softer, going into a massive week next week. Coming up, the morning calls, and later, it's the Bulls versus Bears. Luthold Group's Jim Paulson seeing a new bull market. BlackRock's Kate Moore saying not so fast. Kate joining us around the opening bell.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
5 minutes away from the opening bell. Equities down by 0.4% on the S&P, down 0.5% on the Nasdaq. That's the price action. Here's some morning calls for you. Let's get you a couple of those calls right now. The first one from Wells Fargo, upgrading its Netflix price target from 300 to 400. The analyst highlighting better content and global connectivity as tailwinds in 23. Barclays raising its price target for Chewy to 35, citing better than expected results across all key metrics amid demand headwinds. And finally, Cowen raising its price target for Broadcom to 555. The analyst citing amazingly consistent execution in results. That stock is positive by 3%. Coming up, more on Broadcom's results around the opening bell, and it's the bull versus bear debate. BlackRock's Kate Moore says, stay cautious. Your opening bell up next.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Seconds away from the opening bow this morning. Good morning to you. Going into the open, futures just a little bit softer, lower, negative, down by 1/3% on the S&P. On the Nasdaq, down by 0.4%, coming off the back of hotter than expected PPI data in America, the appetizer for CPI down into next week. There's the opening bow. Switch at the board and get to the bond market. Yields look like this on a 10-year, up 4 basis points to 352.52 in the FX market. Just a touch of dollar strength. Euro dollar down by 0.2%, 105.38 in the commodity market. Crude, just whipsawing everyone this year. Crude right now, 71.80, up by about 0.5%. About 15 seconds into this, we're negative by around about 1/3% on the S&P 500. No real drama here. On the Nasdaq, we're down about 0.4%. One stock to watch at the open, Lululemon. The stock on track for its biggest drop since September after delivering weak fourth quarter guidance. The CEO saying on an earnings call, the external environment remains challenging with several high volume weeks still in front of us. Abby has more. Hey, Abby.
Hey, John. Yeah, tough report for Lululemon. The stock, as you were just mentioning, reacting poorly. What's interesting, on the surface, it actually appeared to be an okay quarter. They beat both top and bottom line. But when you lift the lid, inventory is not just bloated, almost doubled, up 85%. That's really incredible. I'm actually not a Lululemon shopper, but my first thought is I've got to run up to that store on 3rd Avenue and see what I can snatch. But of course, that's going to mean deals. So inventories in the third quarter of 2022 swelling to almost $2 billion. And apparently this, really weighing on gross margins. They weren't so light, but almost 1% light of the estimate, coming in at 55.9%, really moving in the wrong direction over the last year. There was a little blip up midsummer, but overall down on the year. Management, as you were just mentioning, talking about the challenges, but they're also saying that these inventories, the third quarter inventories, it's a high water mark. It will get better. But I think the reason that we're seeing the stock react so poorly, this chart here that we're taking a look at, John, shows Lululemon on the year outperforming the discretionary and the textiles indexes. Valuation at 33 times forward. That's roughly 35% above, say, Nike, Puma, and some of its competitors. Investors wanting perfection in this tough environment. They certainly didn't get it here. They're selling those shares. And now Lululemon about even on the year. All things considered, though, that's a lot better than the S&P 500, down about 15%.
That's a good point. Abby, thank you. The stock lower all morning. Different story for Broadcom. That stock is higher by about 2%. The company giving analysts an upbeat sales forecast, with the CEO signaling corporate tech spending remains strong on the West Coast. Here's Ed Ludlow. Morning, Ed.
Yeah, good morning, John. Broadcom continues to buck the trend of what we've seen in the chip space. Their fiscal first quarter guidance of $8.9 billion in revenue above analyst expectations. And you're right that actually strength in corporate spending is the main message here for a company. Remember, this is a CEO last quarter who called his earnings surreal. Now they're kind of coming to terms with how they're managing a backlog of orders, managing extended lead times, and delivering chips only to the customers that are ready to use them immediately. This is a stock that has outperformed its peers, although it's still down year to date relatively significantly. Of course, there's been a real correction in the semiconductor space year to date. There is some concern going into 2023. Analysts, of course, are excited when you look at the stock this morning about the capital return thesis with this company, but there are pockets of slower growth, and that is definitely in the handset. If you think about Apple and combine that with Foxconn, those are the biggest sources of revenue, and that's a market that Hock Tan CEO would grow in the low single digits, not in the same way that the rest of that enterprise and corporate business is coming in.
Ed, can we pick up on Tesla as well? That stock is up by about 0.6%. I just want to share our most recent up-to-date reporting with our audience. Tesla will suspend output in stages at its Shanghai electric car factory from the end of the month until as long as early January. This according to people familiar with the matter, amid production line upgrades and, Ed, slowing consumer demand. And my question, Ed, for the company at the moment, and we didn't have immediate response to requests for comment from the company this morning, is whether it's more about line upgrades to the production line or more about softening consumer demand. Which one is it?
Probably upgrades. This is something that all automakers do. Tesla certainly has done it each year that the Shanghai plant has been operational, which is not too many years. Remember as well that in the month of January, particularly late January, that is when we have the Chinese New Year, and it's not unusual for companies to use that downtime, so to speak, to make upgrades. That said, the news flow around Tesla and this stock is intense at the moment. There is a lot of concern about the demand picture in China, largely because not just Bloomberg, but many media reports about the pullback in production overall in Shanghai. There hasn't been a clear response from Tesla, and you look at a number of investors reaching out to IR and saying, hey, can you tell us what's going on here? But in this case, according to sources, it's very much focused on upgrading the assembly lines.
Thanks for that clarification, Ed. Appreciate it. The stock is up by about 0.8%. Right now, equity's down by 0.2% on the S&P 500. On the Nasdaq, we're down about 0.5%. You're familiar with the consensus forming around the economic picture next year. Ugly. Luthol's Jim Paulson saying markets already priced in the damage.
The lows are in. And I think we're starting a new bull market. Strategists are usually optimistic, that they're this pessimistic. And I think if that's wrong, and we are past the bear, and we have a modest or no recession and starting a new bull, I think the returns could be really pretty phenomenal, something around 5,000 in the coming 12 months.
Kate Moore of BlackRock taking the other side of that. Quote, equities still don't reflect the damage we see ahead. We're underweight. The trigger to turn positive is when the damage is priced and visibility on the damage improves risk appetite. Kate, I'm pleased to say, joins us right now. Kate, how much damage do you think there'll be?
Okay, so John, I just need to be clear because I heard the preamble.
Sure.
I am not what you'd call, a terrific bear at this point. In fact, I still see some opportunity in equity markets, but kind of over the medium term. I think where I'm more cautious in the very near term is that, you can't really make a buy argument on either the fundamental or the valuation side at this moment in time. Multiples have re-rated a little bit higher over the course of the rally. Really, no one knows what earnings are going to look like in 2023. I feel bad for the analysts that have to put out forecasts when the uncertainty factor is so incredibly high. And if you can't make either a valuation or an earnings argument, then most of the sort of opportunity in the equity market is going to be around trading the technicals and sentiment. And there you have to be very tactical. So I just feel like in the near term, we need a little bit more clarity, both in terms of data, maybe a little bit more information on the path of policy, and more concrete details around the macroeconomic environment, not just in the US, but in China, as you guys were talking about earlier, and other places over the course of 2023. That said, John, I need to say this. I do think, just as Jim was mentioning a moment ago in that clip, there's a decent probability that the super bearish economic and earnings calls for 2023 are not going to prove right. In fact, there's a chance that things are more resilient and we'll find some interesting buying opportunities in the first quarter.
Interesting. So what would lead you to believe that at the moment? Is it the incoming information? Kate, what is it that gives you that picture for early 23?
Yeah, so on the corporate side, I would say what I'm really watching and frankly listening to is what companies are talking about in terms of how they're preparing for a recession. We already know that every economist on the street is forecasting a recession. We already know that most CEOs from many of these recent surveys have said they expect a recession in 2023, but that means that everyone's preparing for it. And so we're seeing companies streamline their businesses a little bit. They're cutting excess headcount that's not necessary or places where they overhired. They're thinking about their investment in CapEx plans for 2023. They're getting a little bit more defensive, which means that once the economy downshifts, they're going to be in pretty good position. I would say, John, we never want to bet against the dynamism of the U.S. corporate.
So at the start of the quarter, when you and I caught up, you said it was too soon to have confidence in EPS forecasts next year. Got a sense that that's the same thing right now, Kate, but based on what you've seen recently, has that given you a clearer picture than you had at the start of the quarter?
Yeah, look, we know there's a big gap between what bottoms-up analysts are saying in terms of, earnings and what top-down strategists are kind of pricing in based, frankly, a lot on macro forecasts. So I think there's still some room for adjustment on both sides. That said, I do think that companies are going to really work extremely hard at defending their bottom line in the cost cutting, managing higher input costs, managing slower demand, and perhaps slightly slower revenue growth. And so I don't think that earnings are going to be catastrophic next year. I actually can envision a world where we're flat to slightly up in terms of EPS.
Okay, well, if that's the call, where do you want to add risk right now, Kate, as you look across the equity market?
Yeah, John, there are a couple places that I still like. I know you guys were just talking about energy a moment ago. On the resource side, those inputs into both new energy and, net zero, economy plus traditional energy, I think will be continued to be fairly well bid throughout 2023. The supply-demand balance across both industrial metals and energy, I think, is going to be quite constructive. I think that there are pockets, and this is going to be more idiosyncratic, frankly, in the consumer that are still worth keeping an eye on. And I really continue to sort of do some more work on the software and technology side. Companies that have massively derated, but have the opportunity to really generate significant free cash. I think the technology CEO and CTO surveys have basically shown that spending will be solid throughout the course of next year, even in a weaker economic environment, and benefit software systems and platform.
Okay, you mentioned energy. Just briefly, what do you make of that disconnect, if we can call it that, between what's happening with the commodity price, the price of crude right now, and what's happened with energy equities through this year? One is down and one's up in a massive way.
Yeah, I'm going to echo actually a comment that Stuart Kaiser made a little earlier on your program, which was, the story for energy equities is not just about earnings or just about the oil price. It was also about re-rating. I mean, the sector had been beaten up, multiples had been in the trash, and so there had been some adjustment back to normalcy. I also think we need to remember that energy equities are going to be pricing in, future prices as well as future demand. And I think these companies are looking forward, and we're seeing companies that have had awesome supply discipline and a CapEx discipline and demand that is likely to remain more elevated than people had originally expected when they were expecting a kind of a light switch flip into new energy.
Okay, can I squeeze in the banks as well? Inverted yield curve, people talking about the end of the tightening cycle of the Federal Reserve. Tightening cycle, which, let's be clear, didn't really benefit these big banks in a material way this year. Kate, where are you on the financials into 23?
Yeah, I'm modestly cautious at the moment, especially on the U.S. bank side. I think it really depends on, if the bank is geared towards more the consumer and what segment of the consumer. I think there's probably a little bit more softness ahead in the low-end consumer, even if over the balance of next year they can get a little bit better. The trading, M&A, and sort of overall investment banking activity outlook is pretty murky. And so I'm not sure I'd be taking a lot of additional risk across the U.S. financials at this point.
Okay, I have to say, you've turned out to be way more constructive than I anticipated. Kate Moore there of BlackRock. Kate, fantastic to catch up with you. It always is. Coming up on this program, winter arrives in Europe.
What I do fear is if the winter does get colder, clearly gas supplies will start to be used up. You could see a spike in some of these gas prices.
That conversation up next.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We've had a mild winter so far, which has been great because that meant gas prices could come down. You didn't get a spike in gas prices in the way that people feared as you started winter. What I do fear is if the winter does get colder, clearly gas supplies will start to be used up. You could see a spike in some of these gas prices. The energy complex still remains incredibly tight.
Cold weather in Europe sending gas demand surging. Germany's network regulator warning the country needs to save more gas. The agency's president tweeting the following: "This should not continue." Germany's economy minister seeking to calm fears of a shortage, saying, quote, "If we manage to continue the energy saving as it's currently done, then we will have enough gas for the winter." The situation in Europe developing as China is pledging to expand oil trade with Saudi Arabia. Team coverage starts right now with Bloomberg's Anne-Marie here in New York alongside Maria Tadeo in London. Maria, first to you, winter's arrived. Just how bad is it going to be?
Oh, it's right here. And Jonathan, it's cold. And this winter, well, we're going to see the first real cold snap for the season. Europe going minus on Saturday. And Jonathan, I don't know about you, but when it gets cold, usually I like to turn on the heating, but that is the problem this year. Of course, if you turn up the heating, that means you go into storage. If you deplete storage, the chances, the possibility of blackouts increase, and that could send Europe closer to a recession. And that's why you had that warning very clear from the German regulator. We need more efforts. We need to save energy. On top of that, and I think this really encapsulates the mood in Europe at the moment, you have the French president, Emmanuel Macron, also saying there is no need to panic for the time being, but we have to use common sense and be responsible, all of us.
Latest comments on Russia, AMH, from the president of Russia, Putin, saying they might cut crude output. Your take on that?
Well, he said they might, right? So it's still TBD whether or not he goes through with this threat. Putin has said repeatedly that anyone who abides by the West, the G7's oil price cap, which, Jonathan, we now know is set at $60 a barrel, that he will potentially not sell to those people, but also saying that because of this price cap, and they're coming out with a decree, Russia, in the next few days, he says that they might cut their production. But what did we see immediately after this response? We saw oil prices rally. This is the exact intention Putin has. A higher oil price is good for him. With Urals trading at $50 a barrel, potentially he could fetch a little bit more for his product.
Anne-Marie, just in terms of the SPR, is that still happening? Are we still selling that down, or are we talking about buying now? Because I get people sending me messages saying, when are we going to refill the SPR? It's not quite clear to me as to whether we've finished selling stuff from the SPR.
Yeah, well, we were finishing around this time, November, December, about the final drawdown. Now the talk definitely is about refilling it. And Amos Hochstein, the president's special advisor, he's really his energy aide, talked about the fact recently on Bloomberg TV that if there's a sustained prices, this level at $70 a barrel, that's when they would be looking at it. But Jonathan, to be honest with you, when you have WTI already around 72, we've been breaking down a little bit due to the macro environment. I think they will potentially wait until those prices are sustained more closer to $60 a barrel, not 70.
One question that we've been asking over the last couple of days, Anne-Marie, and I'd love your thoughts on it, whether OPEC Plus was right to do what it did a couple of months ago. And I suppose that's difficult to answer based on what's happened with the SPR. But based on where crude prices are and how the demand backdrop is developing, was OPEC Plus right several months ago?
I think Riyadh feels that there's a lot of vindication right now that they have in the market, given where prices are. I mean, look where gasoline prices are in the United States. The White House is very quick to always tout that. Right now, they're well below sub $3.50. What we do know from Abdulaziz, the kingdom's oil minister, early on in the pandemic, he really wanted to make sure they were cutting production. And he had this quote, I wrote about this story at the moment as a scoop, but now he goes on and talks about it publicly. He said that if your house is on fire, are you going to use a garden hose or are you going to call the fire brigade? And he would equate that to what's happening right now. That what they did, that 2 million barrel a day cut, was needed in this market.
AMH, do you want the Tadeo exclusive? Would you like that now?
Yeah, she won't tell us, so Maria, who are you voting?
Can we clear this up? Spain's out of the World Cup. Who do you support now? Have you chosen a team?
I've not for the final, but we know there's an important game tomorrow. England, France. Everyone is asking me, who do you back? I've done my research. Spain is out. This is completely objective. And I have to say, it's Allez le Bleu. It's the French. The French have it. They have a killer lineup. No chance
For someone
for
sitting
England.
in London right now.
I know.
MH, that's pretty
I could
punchy.
watch Mbappe all day, but I'm going to go with England. Maria's sitting there. I lived there. My last name is British. I'm rooting for England. Maria, I'm a little bit disappointed in you.
And I got a lot of hate already here.
No doubt about it.
I'm concerned.
Maria, great to catch up as always alongside AMH. We appreciate it. Looking ahead to next week, I have no idea what Maria's playing at in London, talking about Allez le Bleu. Let's talk about next week. CPI, the Federal Reserve, an ECB decision, US retail sales, PMI, CPI. Take your pick, Mike McKee. You've got a busy one next week, haven't you?
And you left out the semifinals of the World Cup. I mean, that's going to
On
get...
Fed decision day, Mike
Yeah,
McKee.
exactly.
Can you have a word with Chairman Powell about moving that news conference?
Bad scheduling time there. It is going to be a kind of a crazy week, and everybody's focused on the central banks, depending on your continent and depending on your currency. But the Fed is going to drive everybody's thoughts. We have a new survey out today that suggests that the Fed is going to raise rates, the terminal rate, to 5%. That's this economist surveyed by Bloomberg. This is not the Fed funds futures markets, but look how long they're going to leave it there. All year. Doesn't start to go down until 2024. So the Fed is starting to get its message across. We'll see if that carries into next week and into the markets. We're also looking at inflation forecasts that have inflation dropping fast next year. The question is going to be, does the Fed see it the same way? They were very optimistic in September. Do they still see inflation coming down as quickly into 2023?
Mike McKee, looking forward to your coverage next week. CPI, the Federal Reserve, and a whole lot more. I want to get you some sector price action just briefly on this equity market in front of us, which is only down 0.1% on the S&P. Here's Abby with more. Hey, Abby.
Hey, John. Well, to use your language, not surprisingly, not so much drama, considering that we are just looking at very small fluctuations at this point. We don't have any sector that is moving more than 0.5% to the upside or to the downside. The best sector on the day right now, communication services, up 0.4%, being helped out by some of the usual suspects, including Netflix at more than 3%. Interestingly, tech, on the other hand, another piece of the mega cap tech silo, it's actually down 0.5%. This, of course, as yields are pushing higher. On the week, though, it's a different story. Lots of drama. We have lots of down sectors. In fact, 10 of the 11 sectors are down. Some of the worst include energy, communication services, and then also, of course, discretionary, John. This is the worst week since November 4th.
Abby, thank you. Looking ahead to next week. I feel like I've been looking ahead to next week for the best part of a month. Coming up, I'll bring you the trading diary, next couple of events to get you into the weekend, and then it's on to the big week next week from New York. This is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
25 minutes into the session, equities down about 0.2%. That's the price action. Here's the trading diary. Coming up over the next week or so, at the top of the hour, we start with UMich Consumer Sentiment Survey. Then we look ahead to the big week. It's US CPI and testimony from FTX founder Sam Bankman-Fried on Capitol Hill. That's all happening on Tuesday. On Wednesday, a Fed rate decision and Chair Powell news conference, followed by decisions from the Bank of England and the ECB on Thursday, plus another round of jobless claims and retail sales in the United States. A big, big week to close out the year. From New York City, that does it for me. It's time to go to the World Cup and get away from markets for a little bit. Have a wonderful weekend. This was the countdown to the Open. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 138, also 3 times a month. Also, there was a time my father was hospital due to heart failure, Still, he had to attend the 2-branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in a hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted.
Hello traders again. As you can see, basically position opened for euro just right here at 105.56. Stay with me. We're going to place stop right now straight away at 105.46. So we're already 1,000 pounds in profit. So well done, all of you guys who decided to copy this trade. You're already in profit, but we didn't sell, we haven't sold it yet because we are in profit. Okay, stay safe, and I'll speak to you later, guys.
She leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Benegold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.